morning, everyone, and welcome to our discussion today on the Paycheck Protection Program loan forgiveness. We're going to get started here in a second. I'm going to wait for everybody to join. Thank you for joining us this morning. Thank you all for joining. We're going to get started here in just a second. It takes just a minute for everyone to kind of spool in. All righty, we're going to go ahead and get started. Thank you again. I'm Kate Shanks. I'm Vice President of Public Affairs for the Kentucky Chamber of Commerce, and welcome to our Restart Kentucky webinar. This morning, we are going to be talking about the Paycheck Protection Loan Program forgiveness, which I think is a very timely issue for us to be discussing. We've got some new guidance and information out, and we've got some great experts that are joining us today that are going to be answering all your questions that you have going forward on this important program and the loan forgiveness piece of it. Before I welcome our panelists this morning, I do want to thank our sponsors in the Restart Kentucky effort, the Kentucky Community and Technical College System. They're a great partner of ours, work with us closely on a variety of different issues, and we really appreciate their leadership on so many important topics. If you're new to Restart Kentucky, this is a program that we put together back in the spring to really help us educate business leaders and others about the pandemic, our response to the pandemic, how we can essentially recover from this great economic crisis. We started in the spring. We've had over 20 webinars, a lot of great information on our Restart Kentucky website. I want to encourage you to visit kychamber.com and click the Restart Kentucky banner at the top of the page, and you can get access to the recordings for all of the different sessions that we've done since April, the Healthy at Work requirements, and we also keep an updated reopening schedule on our website as well as things open and sometimes close and then reopen again. So there's a lot of great information on that website, and I really want to encourage you to take a look at it. We will be recording this webinar today, posting it up probably later this afternoon. So if you have to step away for a moment, or if you want to revisit part of the conversation, it will be recorded and posted on our Restart Kentucky website. That's one of the benefits of this virtual environment, is that we can provide this content for you all after it's gone live. So thank you again for joining us. We really appreciate you being a part of this. And I want to welcome our panelists today. We have some really great experts joining us. We have Diane Medley. She's Executive Chairman for MCM CPAs and Advisors. We have Todd Fassard, Market President and Senior Commercial Banker at WesBanco. And we have Brian Cromer, Chair, Business and Finance Service Group at Stites and Harbison. And they're going to be walking you all through some really important content today about the loan forgiveness program. And so with that, welcome to our panelists. Thank you. And I will go ahead and turn it over to Brian as Diane gets our PowerPoint loaded, and we will get started.
Okay, terrific. Well, good morning, everybody, and thank you for joining us. I'm Brian Cromer. I'm the chair of the Business and Finance Group with the law firm of Stites and Harbison. I do want to put in a quick plug for the Kentucky Chamber. In addition to supporting your local chamber, we're at our firm, we're privileged to do a lot of work with the chamber folks, and Ashley and Kate and the whole group there, they're terrific. So I would encourage you to get involved. They're just a great advocate for the business community. I'm going to go through, give you a little bit of an overview of the Paycheck Protection Program, sort of how do we get where we are today. This is a brief description and a timeline. So if you go back to March 27th, which seems so long ago, it's really kind of hard to believe. That is when the CARES Act became law, and that was a $2 trillion assistance program, stimulus plan for individuals and businesses. And included in that was $349 billion allocated to the Paycheck Protection Program. And it's important to know that came under, as a streamlined version of the SBA 7A program. And the intent was to incentivize small businesses to keep workers on the payroll is quite different from 7A loans. That's always, the 7A program has always been very popular, but it's more of a traditional loan underwriting process. And as I'm sure you know, the Paycheck Protection Program has followed a different model, much more streamlined. And obviously the key is the loan forgiveness piece, which we're going to talk about at length today. If you'll recall, at the time, that was set up as first come, first served. Businesses were encouraged to apply quickly. And I still find it hard to believe, thinking back, that those funds were fully depleted in less than 2 weeks, $349 billion in less than 2 weeks. April 24th, later that month, an additional $310 billion was appropriated to the PPP program, but that was against a backdrop of new SBA guidance emphasizing the importance of the program eligibility requirements. And I think it's fair to say that there was some controversy that went along with who got some loans, and led to changes in the rules, and I'll talk about those things a little bit later. I also think it's fair to say, when you look back now at the PPP program, that rollout was pretty rocky, and maybe that's to be expected given the size and scope of the mandate. It's also, it's hard to think of a program where loans were made and then material changes were made to the program. At one point, if you weren't watching your screen on a daily basis, you were kind of miss what was going on. And we have also seen multiple guidance, regs, amendments to the act, and frequently questions were answered that were answered in guidance, and the end result was more questions. I think that's people would generally agree. So, Diane, if you could, here we go, good deal. So fast forward, so where are we today? Through August 8th, that's when the PPP loan application process closed to new applicants. So all in, we've had 5.2 million loans for $525 billion that have been approved. And of those, 4.6 million loans have a loan size of 150,000 or less. So that's well over 80% of the total amount of the PPP loans. And 29,000 of those loans are greater than $2 million. And that's significant in that anything over 2 million is going to get an automatic full audit by the SBA. Kentucky, businesses in the Commonwealth of Kentucky received over 50,000 loans for $5.3 billion. When you consider we're a state of 4.5 million people, and you think about the size of our state budget, for example, that number's, it's a big number. So after the dust settled, there was over $130 billion in PPP funding that remained. And there's been a lot of debate in Washington about whether those monies should be repurposed. Should there be a PPP 2.0? And we'll talk about that. On August 10th, the loan forgiveness portal opened. And that was accompanied by much anticipated guidance. And we're going to talk about a lot of that today. It does sort of beg the question, why haven't we seen a large wave of forgiveness applications being submitted? And there are many reasons for that. At this point, borrowers are not sure whether there's going to be automatic loan forgiveness. That was a subject of pretty intense debate earlier this week. Will there be more guidance? Are there going to be changes to the program? What's on the horizon? There seems to be bipartisan support for a new PPP round, but to be the master of the obvious, the political climate's a little hard to handicap. You know, there are tax issues about expense deductions. Are those things going to be resolved? Will borrowers who already have one PPP loan be allowed to get a second PPP loan? So hopefully that sets the stage for our discussion. Before we jump in, I do want to say as a cautionary note that the law and guidance on this area, that it continues to develop. There are a lot of interpretive questions. So we would all recommend consult your advisors before taking any action regarding this information, because it's all a very, very fluid process. So at this point, I want to turn it over to Diane for the next portion of the program.
All right. Well, as Brian discussed, it's been a rocky period since this rolled out. There was a lot of uncertainty. We did our best to clarify it with our clients and doing a couple of these webinars for the chamber. But there's been more resolution on some of these questions. We have probably 2 or 3 that are still, in my mind, unclear. That may stay. We may not get clarity, perfect clarity, like we like to have as accountants or some business owners. So on some of these issues, we're going to need to do the best we can and rely on our bank to assist us in getting this done and through the process. So as far as some of the issues that I want to highlight that have been clarified, and I'm going to give you the short answer. There's a much longer answer out there. On the accounting for these loans, how do you account for it on your books and on your taxes? I'm going to go into that a little bit more later. But in general, we're saying you treat it as a loan until the amount is forgiven or fully paid. The accounting folks in our shop say you would accrue interest on it to be totally accurate, even though you're not going to be paying it, and then record a gain once the loan is forgiven. In applying for a PPP loan or the forgiveness, which is where we are now in the process, can you apply early? Yes, you can. You can apply once you're fully forgiven based on your spending, but there are some caveats on being careful about some of the reductions that you could be dealing with. I'll go into that in a little bit more detail in a few minutes. The covered period, there's a question out there, can you use a covered period other than 8 or 24? And the answer is no. So when you're applying and you're filling out your form, you either check 8 or 24, even if you don't need the full 24 weeks. So if you're applying early and you're using 12 or 16, the SBA says check 24. Don't try to white it out and put in some other period. Just a quick note on idle loans, because there are a lot of people who have got relatively small idle loans. We've got a few clients that had larger ones. If you took an idle emergency advance up to the $10,000, that amount will reduce the amount forgiven. That'll be taken into account once the loan is processed. So there's no way around it, no way of spending your way out of that. Can you get both an idle and a PPP? Yes, but technically you need to use the proceeds for different expenses. That doesn't mean you can do some payroll on one, some on the other, but you need to keep good records of what you're spending these funds for. And then what are acceptable uses of PPP versus idle? Again, nothing changed drastically on the PPP side. It's wages and benefits, rent, utilities, certain interest on secured loans, where the idle loans are more broad. You can do those on more varied types of business expenses. Just to go back to that, I know there's a lot of articles out there on fraud, and the biggest thing on this fraud issue is one of them is do not think you can spend this money on business assets, purchases, on boats, cars, distributions, etc. Just be real careful on that, because that seems to be a real hot button in the fraud area. Couple more issues on the FTE side, and we got really into FTEs over the last few months on how to calculate them. Nothing changed on that recently, but the question is, they did add a couple of exceptions. One, there's a blanket exception. If you cannot get an employee to come back, that employee is fired for cause, resigns, and there's a few other items, that person will not count against you because you did your best to bring them back. So I think that was a really good add or clarification from Treasury, that it's not, if you couldn't get them to come back for various reasons, including if they wanted to stay on unemployment, that person does not count as a reduction. Another nice addition was they added an exception that if you are not able to operate your business in the same manner as you did in 2019, you can claim an exception for all the FTE reduction. I would caution you to make sure you read that exception carefully, because it basically says you were not able to operate your business in a manner consistent with the same time period in 2019. But it does cover the period from February through your filing date. So just be careful about that you're not unduly relying on that broad of an exception. A lot of wrangling and discussion about owner employees and how to limit them. It seemed like the Treasury really took it upon themselves to not allow owner employees, and that would be folks who are partners, who are sole proprietors, who are partial owners in an S Corp, partial owners in a C Corp. I think they really just didn't feel like those owners should get near as much benefit as a regular employee. So they did issue an IFR, and this is a technical release where they defined an owner employee, but they also, they said an owner employee is an owner in a S Corp, a C Corp, a partnership, or a sole proprietor that earns compensation and is also an owner. But then they clarified in the summer that said that for S Corps and C Corps, if they have less than 5% ownership, they would not be subject to these rules. So in that case, they would be eligible for the full limit of $46,154 for a 24-week covered period. Very important that those small ownership stakes were exempted from this. However, partners are still subject to the limitations. They did not get this 5% exemption, and they're limited to $20,833 for the 24-week period. And also be sure to know that for partners and sole proprietors, you have to use your 2019 actual net income rather than 2020. Just a little bit more of a refresher on this issue, because it is, I think it's prone to error, at least it is with our client base. So you have to be super careful, remembering what type of entity you have. And you also have to be aware of the ownership percentage. So again, just as a review here, if you're not an owner and you're under the 8 weeks, the limit's $15,385, but it jumps up to $46,154 under the 24-week rule. However, if you are an owner employee under the caveats that I just mentioned, you're still got the same rule of $15,385 for 8 weeks, but you're significantly limited to only $20,833. The $20,833 is basically 2.5 months of compensation with the $100,000 limit. Getting into even more detail, the Treasury was also very intent on limiting owner employees' health insurance and retirement costs. So we have a chart here that I'm going to go over in general, and it's a chart that I reference daily now just to make sure I'm not misstating anything, because as you can see here, there's 3 different types of benefits and there's 5 different scenarios. So in general, if you're self-employed as a Schedule C, a Schedule F, or a general partner, you will get no benefit from health insurance, retirement, and of course you would not have any state and local unemployment anyway. If you're an S Corp owner, you would not get health insurance. You would get retirement, but it's limited to the 2019 contribution prorated 2.5 over 12. So in other words, you're only getting 2.5 months worth of it as a limit. You would be able to claim the your own amount for state and federal unemployment. Now, another caveat, family members, if you're a 2% owner and you've got family members employed, those, as you can see, are basically the same rules as if you're an owner employee. So be careful about that. And then the C Corp owner, they got limited, but not quite as much. They got their health insurance. They get their retirement, but again, it's limited to 2.5 months worth of it. And they get the unemployment. So just be careful with these rules to make sure you're not doubling up or claiming too much on this. Skipping now to another hot topic, it's rent. Again, when the law came out, we thought that pretty much rent payments would be fully forgivable as part of your use of funds, but they became subject to some limits, so we're going to go over those. The first one is if you're leasing out part of your business or only using a part of the real estate, there's going to be some limits. For the first limit under this scenario is if you would not be able to take amounts that were subject to a subtenancy. For example, if you're paying $10,000 in rent, but you've got a subtenant paying $3,000, your amount is only $7,000. That makes some sense because probably that subtenant might have a PPP loan for themselves. If you've got any kind of allocation of mortgage interest, you can only do it based on a percentage of the fair market value of your space. And any other expenses such as utilities must be prorated as well. If you have a home-based business, you're going to be looking at your 2019 tax filings and using an amount comparable in calculation to that number. So most of these make sense. It does feel like they're nitpicking in a way, but I think we can deal with it. The next issue was more problematic because this one said if you're paying rent to a related party, and as you know, there are certain criteria for that, you will not be able to deduct or use your rent as a part of your forgiveness calculation unless, only to the extent that you have mortgage interest on that underlying property. So if you have no mortgage on your underlying property, you would get no amount for this category. And in addition, mortgage interest payments to a related party are not eligible for forgiveness. So they really hit this hard. Another area that's been a lot of discussion about, a pretty small item, deals with utilities and what's included. And the reason was, I think the world of utilities has changed a lot over the years. So there is some disagreement on this. The items that are in regular print on this response are clear: electricity, water, telephone. The other items that I've got in italics, we feel like are eligible: gas for company autos. The term transportation is used, but there's no clarification. Internet, garbage and security monitoring. The AICPA has listed a document that lists all of these items as eligible. A couple of items that are still outstanding that I'm going to go into and let's let you understand where our concern is. Then it will be up to you, your bank, and or your advisor to make a decision on how to proceed. The two areas are, if you're applying early, how do you treat the salary wage reduction or limits? We're saying you probably need to prorate. And the other question is, can you outspend your FTE reductions? And we're waiting on guidance on this. In my opinion, we may not get it. So we have a form that we can use to calculate this, and we'll go with that. At least that's what I'm recommending to our clients. So let's just get in a little bit of detail with these two issues, and hopefully you'll understand where the concern is. The first question is, can you outspend your loan and effectively outspend the potential loan reductions? So for instance, you've got a PPP loan of $1 million, but you have an FTE reduction of 30%. You spent $1.5 million on eligible expenses. So in theory, 30% of that $1.5 million could be a $450,000 FTE reduction. However, the way the form works, you take the PPP expenses, $1.5 million, you take off the $450,000, you net it down to $1,050,000. If you go back up, your loan was only $1 million, so you would get full forgiveness. The issue is, that seems really nice because it negates the FTE reduction altogether. And that's the way the form is. So the concern is, will the Treasury and SBA at the last minute come back and say, you've got a 30% reduction, and it would apply to the loan amount, not the expenses. You know, we're at the point, and Todd will go into the bank process at the moment, where loans are being processed. The banks are okaying them. They're getting sent in. And if the form says this is the way it works, that's what I would recommend we go with. But we're just letting you know this, just to be aware that something could come out of left field, and that won't be a good day if that happens for the banks or the accountants. The other issue that is an issue as we're helping clients right now prepare their calculations, you know, if you go the full 24 weeks, you basically got $46,154 of wages that you can count. And that's a 24-week proration of $100,000. But look at the chart here. If you're using more than 8 weeks, but less than 24 to spend your PPP loans, it's unclear, because do you get the full $46,154 when technically you didn't use the whole 24 weeks and you actually filed before that period ended? Or do you get to use, or have to use, $23,077? If you look above, that would be, say, 12 weeks. If you use 12 weeks of expenses, do you prorate the limits based on the 12 weeks you used? Or do you fall back and only get the 8 weeks? So I always like to end something like this, not as a mystery, but as what would I do in this situation? I would do the calculation, and if I could fully use my funds using the 8-week limit of $15,385, I would go ahead and file now. But if I can't get there, to be on the safe side, I would wait till the 24 weeks is up. That's my conclusion on that one. Todd can weigh in on that when he gets his presentation going here. There's one more issue I want to cover, and this does not apply to everyone, but if you're a company that has an R&D credit that you are using on an annual basis, and these are really beneficial to a lot of companies, especially in the manufacturing arena. The issue there is, since these expenses that are forgiven under the PPP program are not deductible, they technically now don't qualify as R&D expenditures, because that's one of the qualifications. So they would not be considered QRE, qualified research expenditures. So you have to be careful. If you look at the planning options, there's no current, there's no one has addressed this that we can rely on. But if you're in the middle of it and you need to make a decision, if you're a company that's received a loan and it's not been forgiven, at that point, there's no reduction in expense. And the QRE would technically not be reduced. However, that next year, when that loan is forgiven, you're going to have non-deductible expenses. So what we would recommend at that point is allocate as much as you can on the PPP program to non-payroll. So in other words, you haven't reduced payroll for some of the payroll you need for qualified research expenditures. And alternately, and probably in addition to, allocate some of the cost of the PPP loan or most of it to non-qualified employees when possible. In any event, we would also recommend just delaying and extending until we get some guidance on this so you can be more comfortable. Again, if you're not in the R&D credit world right now, you can ignore what all I just said. But if you are, you probably are getting some advice on this anyway, but just be aware it's a very sticky situation at the moment. And Brian, we'll turn it back over to you.
Sounds great. Thank you. I'm going to cover a couple of different topics, both of which are pretty complicated and have a lot of different moving parts. And I'm going to just try to give a high-level overview of some things that you need to think about. And the first one of those has to do with mergers and acquisitions and the sale of a business or the sale of business assets. In general, what do you need to know if you're buying or selling a business and there are PPP loans on the scene that haven't been paid off or forgiven? What do you do? So there are a couple of things that are sort of threshold matters that it's important to know. One is that under the SBA's procedures for 7A loans, and again, as I said at the beginning, the PPP loans are underneath the wing of 7A. Any change in ownership for 12 months after final loan disbursement requires both lender and SBA consent. Both lender and SBA consent. Now, actually, the lender is the one that's responsible for obtaining this consent. But what is a change in ownership? And if you're looking at various transactions, how do you evaluate that? Well, the SBA notice that ties that to the PPP loans doesn't really define that. So that's the first thing, that under the SBA's procedures, there are consent processes you need to be aware of. Secondly, what do your loan documents say? So if you all will recall, a lot of lenders were sort of chomping at the bit, but they didn't have form loan documents from the SBA. So the SBA did come out with a form PPP note, and there are a couple of provisions in there that are of interest with respect to this topic that I've listed in the PowerPoint. One is that a borrower is going to be in default if they have any adverse change in financial condition or business operation that the lender believes may materially affect the ability to pay the note. Secondly, there is a default for if a borrower reorganizes, merges, consolidates, or otherwise changes ownership or business structure without lender's prior written consent. Now I've said here, what about asset sales? Because you can see from the language above, asset, a typical lender loan agreement note would say that, sale of all, substantially all assets would be an event of default, and it doesn't say that. I think although that's not specified above, I think it's safe to assume for planning purposes that this type of language would cover that. So having talked about the SBA note, the bad news is that I've looked at loan documents for many, many different borrowers, and these loan documents are in fact not uniform. Some have used the SBA note, some lenders. Some have come up with their own forms. Some have used existing forms, and then included sort of an overriding provision that, you know, notwithstanding anything to the contrary, if this is counter to the CARES Act guidance, CARES Act controls. So in the event you're going to look to do something like that, it's critical that you look at your documents, and the ones that you signed might be quite different from the ones another business signed. What are the consequences of failure to obtain consent? Well, for one thing, that's going to be a default. You're going to be asked to repay, and I think it's safe to say that there will be no loan forgiveness. So it's a pretty high stakes poker game, so to speak. So in general, on mergers and acquisitions, I think it's a complicated analysis, and it's really important to go through the structuring and planning. You know, PPP loans are fundamentally different from funded debt. In other words, you know, many deals in the M&A space are cash-free, debt-free deals, and regardless of how the transaction is structured, bank debt, funded debt, it gets paid off at closing, and you go on about your merry way. Well, clearly, PPP loans are different because you have the forgiveness element, and if you're going to pay off the PPP loan without going through the forgiveness process, and certainly you can do that, but that's there's a cost associated with doing that, a cost-benefit analysis. What role does deal structure play? Asset sales versus stock deals, drop-down entities. You know, particularly with respect to your lender, how is a lender going to view that? Would a lender say, okay, well, you know, well, one thing we have seen is that there are lenders who are saying, okay, that's fine, I'll consent, but I want you to escrow all the PPP monies. You know, you open an account or however, but you escrow those funds with us pending the completion of the forgiveness process. And you may have buyers in your transaction that would say, if that doesn't happen, I'm going to escrow money on our end. Without getting too much in the weeds on the M&A, you know, you can also sign, can you sign agreements now and close later and have loan forgiveness be a closing condition? So there are a lot of factors to be evaluated. That's a topic that could, you could use a lot of, you know, could use up a lot of airtime on that. The short takeaway is it's important to understand these types of issues before you execute a preliminary agreement, you know, an LOI or something like that, or consummating any type of a transaction. Very, very important. Okay, the next issue I'm going to talk about is the necessity certification. And if you go back to March, the CARES Act had a sentence that said the applicant had to make a good faith certification that the uncertainty of current economic conditions would make the loan request necessary in order to support ongoing operations. That sentence, I think a cottage industry grew up over that, and I'll talk about that in a second, but that was one of the more significant provisions in the CARES Act, and had a very real world impact on borrowers as additional guidance was issued. So when is this measured? Let's say that you applied for your loan and your circumstances looked pretty dire. As we sit here today, in the last 3 months, you've had terrific results. Does that mean that you did not meet the test for the certification? Well, the certification is supposed to be judged at the time you applied for the loan, and it is not supposed to be updated or downdated, for example, at the time you submit your application for forgiveness. I think it's, well, these things certainly are going to be judged with the benefit of hindsight, unfortunately, but the way the program is set up to work, that certification is measured when you filed for your loan, when you applied for your loan. So a little bit of quick history, and this was all front page news. When the PPP loans were established, they were put under the 7A program of the SBA. SBA loans have traditionally been, that's when you're going to the lender of last resort, so to speak. And there's a requirement in the 7A loans that would say you can, one of the conditions to get this loan is you're unable to obtain credit elsewhere. Now that requirement for the PPP loans was specifically waived. The CARES Act says the credit elsewhere requirement doesn't apply. But if you'll remember back when large public companies, there were reports that they were getting loans, and perhaps one of the most celebrated, and maybe that's not the right word, noteworthy one was when the LA Lakers, one of the most valuable sports franchises in the world, and it became apparent it had received a PPP loan. The Treasury and the SBA pivoted to this economic necessity requirement. And if you'll remember, Treasury Secretary Mnuchin issued a series of warnings that you really need to look at this carefully, and that borrowers need to know, or applicants need to know, that there are criminal penalties that can attach. As part of, ultimately there were FAQs and more guidance issued, and part of that where that shook out was the SBA said, okay, well, yes, that's right, the credit elsewhere requirement doesn't apply, but you need to take, and I've got this on the screen, this is another sentence that has been read and reread countless times around the country. You're supposed to take into account your current business activity and your ability to access other sources of liquidity sufficient to support your ongoing operations in a manner that is not significantly detrimental to the business. Obviously, that is quite subjective. What are other sources of liquidity? If you've got other owners who have deep pockets, the business isn't doing well, what does that mean? What if you have untapped lines of credit? There are a lot of issues that are balled up in that. A safe harbor was created, allowing the payoff of PPP loans. Ultimately, that was extended 2 or 3 times, and ultimately that ended on May 18th. So what's the current landscape on this necessity certification? Because it's quite important in the forgiveness process. All PPP loans over $2 million, and also, and I've put it up here, and other PPP loans as appropriate, are subject to a full audit. In fact, on the forgiveness application forms, there's a check the box if you're over 2 million to sort of flag the fact that you're going to get a full audit. After issuances of guidance and a lot of conversation, ultimately, Treasury and the SBA came out and said borrowers with loans under 2 million will be deemed to have made the required certification of economic necessity. In addition, the SBA said, okay, if we find there's not an adequate basis for certification, we're going to seek repayment and nothing will be forgiven as a remedy. Does that mean that administrative enforcement actions are going to be foreclosed? In other words, does that present absolute immunity on the issue? The answer is no, it doesn't. And there are various governmental agencies that could come in and take a look. And as you may know, this process and the look back could potentially go on for 6 years. So the last thing I'll say on this point is, with respect to necessity, the documentation is critical. And what is best is if at the time of your loan application, you put together a contemporaneous record as to why you met the economic necessity requirement. And that could include things like what were your sales projections? Did you have employees that you would have laid off but for receiving the forgiveness? If there are companies that did cash stress tests, some of them tying back to their experience in the financial meltdown of the 2007, 2008, and compare those numbers. But the bottom line is that documentation's critical. Lastly, there is a looming question, I think, not just on this issue, but I think sort of on the program generally, and that's whether the November elections are going to result in sort of renewed focus on the PPP program. There are a lot of political elements to this, and it's possible that depending on how the presidential election turns, the climate could change. So at this point, I'm going to turn it over to Todd to talk about the bank side and the SBA process.
Okay, thank you, Brian. And just want to say thanks to the Kentucky Chamber for organizing the event. Can everybody hear me okay?
Mhm.
Okay, good. So just a couple highlights on the program overall. And some of this may be a little bit repetitive, but just at a high level, I want to say that this has probably been the most rewarding, but at the same time, most frustrating program of my banking career. You know, and I've learned that saying I don't know has kind of come hand in hand with this whole process. But appreciate everybody's patience. I just say, you know, be patient with your banker, accountants, and legal advisors. We're all in this together to kind of work through it. So just to give you a little bit of scope on WesBanco's involvement in the program, you know, WesBanco, many of you may not know this, is a 6-state, I would describe as an emerging regional financial institution and fairly new to the Commonwealth. WesBanco came to the Commonwealth via an acquisition of your community bank. That's been 4 years ago. And now WesBanco has a top 10 market share on as far as deposits are concerned in the Commonwealth. So I'm proud to be involved with Kentucky. Proud to have the presence we have, and hopefully you'll get some good insight from all the presenters today. But we processed about 7,000 applications in total for about $850 million. And while we are starting to accept forgiveness applications, we're doing it on a very limited basis. So I think that from what I hear and talking to other bankers throughout the area in the Commonwealth, that seems to ring true for most. There's a few moving pieces here, and I think Brian alluded to it earlier. You know, we were really hoping that Congress would come together on some sort of streamlined process for forgiveness. You know, everybody's talked about the, you know, applications less than 150,000. I think for most lenders and for us, I know for WesBanco, you know, 80% of our applications were for loans less than 150,000. So that would just make the back end work for everybody much easier. So we have purposely delayed rolling out an automated solution for forgiveness to our broad customer base, just given that, you know, there's some moving pieces here that we hope come together. But in the event that Congress can't come to terms on a streamlined process for certain loans, what we plan to do, at least at WesBanco, is on a large scale, allow customers to start applying for forgiveness. So we expect we'll launch our tool at some point in September, maybe towards the back end of the month. So still kind of a wait and see approach. We also have time to do this, so there's no super rush, but it's kind of time to get going. So keep in mind that the lender does have 60 days to review your application. And, you know, the best advice I can give, and this is going to ring true throughout the slides I have here, and we'll move through these fairly quickly. But, you know, just as it was on the front end, on the back end, organization is key, and how you provide the documentation to the lender is critical. I don't think for organized clients, most lenders will take 60 days to process the application. Matter of fact, for the few we've processed, we've turned those around in the same day. Now, that's not a guarantee once we have a lot of volume hit the system all at once, but I think 60 days is more than enough time. And in a lot of cases, you know, it may take your lender a week or two, I would say, to render a decision and forward it on to the SBA. And then just keep in mind, once the forgiveness app moves forward and is approved by the bank and heads to the SBA does have 90 days to remit payment back to the lender. On the next slide, I think Brian alluded to this earlier, but just keep in mind that there is a 6-year period that the SBA has the authority to review loans. So while the bank can help you with the the record keeping process, and we will certainly be retaining records. Just be cognizant of that, and again, keep your documentation both on the front end and the back end, along with any supporting documentation that's not required to be presented with the forgiveness applications. Just make sure you have that in an organized format, electronically, in the event that were to happen. And now we'll focus more on the forms themselves. And really, as it relates to the forms, I'm going to be focusing more on the easy form. And one thing that I do want to mention that we have noticed in the handful of applications we've processed is some people may not be aware of the easy form. And Diane and I and Brian, we talked about this yesterday. We feel that the great majority of customers will be able to apply for forgiveness using the easy form. So a lot of people may not even know that that's available, but for the applications we've seen thus far, it seems like people, borrowers may be opting for the long form when they in fact may not need to be. So just be aware of that. Really, as it relates to the forms, the Schedule A is a very detailed employee by employee template that is required on the long form. So, if you get into these sort of schedules, I would definitely recommend engaging your CPA. Unless you have a sophisticated accounting team in the office there, and many of the participants in the audience may very well have that. So don't hesitate to use your CPA for some of these more complicated schedules that relate to the longer form, which, it includes a pretty detailed calculation by employee. That could require some work, and you probably want somebody to review that. So going into the easy form on the next slide, I'm not going to go through and read all these fields to you. They're pretty self-explanatory. But just keep in mind with the easy form, there are a few ways to qualify to be able to process an easy form. Number one, if you're a self-employed with no employees, then you can use the easy form. And then number two has two parts. The first part of number two would be if you have employees, if you did not reduce salaries or wages by more than 25%, and did not reduce the number of hours of your employees, or the other qualifying factor to use the form is if you had reductions in business activity as a result of health directives from the local, state level, and did not reduce the salary or wages by greater than 25%. So the thought here is, if you kept everybody on the payroll just as you normally would have, and that was the primary intent of the program, then it would be my advice, and this isn't West Banco's advice, but personally speaking, I would opt to use this form. It's just that much easier for you. It's going to save you time and probably a little heartburn too. It's just an easier way to process the forgiveness application. So the next slide basically is just a pretty brief breakdown of some of the things that you're going to need to calculate, which we're all aware of those. Diane talked about those at length earlier in the presentation. Primarily payroll, mortgage interest, rent, and utility payments. And then line 5, 6, or 7, you take the smallest amounts of 5, 6, or 7, and that is actually going to provide you with the forgiveness amount. So pretty straightforward, pretty easy there. I think everybody can pretty well follow that. And then the next slide is basically, there are 10 in total, I believe, borrower certifications. And I'm not going to read through all these for you here, but this is stuff that we've already talked about, which is basically certifying that you're providing true, accurate information, funds were used for payroll and the other costs identified. And then basically that you have submitted to the lender documentation supporting those costs. There's also some clauses in here that basically says, you're representing yourself truthfully, and there's consequences financially and otherwise if you violate any of that language. So again, 10 certifications there, and then I think you sign and date. And from there, along with your supporting documentation, the bank would review that, and then assuming everybody's in agreement, would move forward with sending your forgiveness app to the SBA. So the next form is the long form, which again, I'm not going to spend a lot of time on that. There's not a, the main differences I think with the long form you're going to be dealing with line by line, Schedule A for your by employee, and then you have this safe harbor provision too that you have to kind of walk through. So it is much more onerous, I would say, and you may have to fill out the long form depending if you couldn't answer those couple of questions. So just be mindful of that. But I think if you're getting into these safe harbor provisions, or if you're getting into the schedules by employee, I would definitely recommend engaging your CPA to make sure that just have a second set of eyes looking at that information. The remaining slides are really focused on documentation that you need to either provide or that you need to retain. And I'll speak on behalf of WesBanco some of the things we're specifically looking for as it relates to payroll. Obviously, the easiest thing to provide would be the third-party payroll reports. And most customers that have an employee base use a third-party provider for payroll. So, I mean, those are reports that typically can be downloaded into a PDF format and then emailed directly to the bank for the covered period. So, from my standpoint at WesBanco, we would love to see the third-party payroll reports. And then in conjunction with that, we would also like to see the Form 941. I think those are the two that we're kind of keying in on from a payroll standpoint. As relates to payroll, I realize that not every small business out there uses a third-party provider. So what I would recommend in that instance is just provide a however you reconcile your payroll reporting. I think a lot of small companies utilize Excel. That would be perfectly fine to provide an Excel report to the bank. And in addition to that, I would just maybe highlight or draw attention to the payroll deduction coming out of your bank statement to support the Excel calculation. And then as it relates to some of the other items, for employee health insurance, retirement plan contributions, canceled checks would be fine. Deductions on bank statements would be fine as well. So the non-payroll stuff, this should be pretty easy for the lender to provide you. I've had customers request this of me, but it's very easy for the lender to provide you with the principal and interest breakdown on your loan payments during the cover period. So I'd reach out to your lender for that, or you may be able to pull that directly off your online banking platform at your bank. And then as far as the lease payments are concerned, copy of the lease would be great. Canceled checks that show the check is cleared to the bank would support the lease documentation. And then utility payments, again, bank statements should have all that detail, whether that's ACH payments that are coming out that list the utility provider, check written, online bill payments, things of that nature would help support that. And then on the next slide, really, this is documentation that we recommend that you maintain, but not required to submit it. And again, I can't reiterate enough, this whole process favors people that are organized with their record keeping, even if, and that includes documents that you aren't submitting. So, this slide particularly focuses kind of on the HR front. So I think this is kind of the HR management documentation slide. So this is just good record keeping for all the various things that are listed here that will help you in the event that you did have a reduction in workforce during the cover period. You know, the documentation as far as businesses that had an interruption in service, you know, I'm thinking of, you know, restaurants, event venues, doctor offices, you know, really any B2C type retail operation would have likely been impacted with an interruption in service. So a lot of this documentation could have been pulled off of, you know, local government or state health websites. But whatever you can do just to document, you know, how long and why you were shut down, you know, I think will be good documentation for you to maintain. A lot of governments posted reopening in various stages, which I'm sure that's all accessible on the internet, should you need to provide it. And I think the last slide as it relates to documentation is just the record keeping. Again, I think the bank is more than willing to help to step up to provide any documentation gaps you may have, because we plan to retain all these records as well. But you know, don't solely rely on the bank. I think maintaining good records, you know, at your place of business is certainly an important thing. You know, back to now we're kind of going on to the long form documentation to submit. You know, again, I mean, basically the long form, which we think maybe 20% or less, hopefully less of the businesses that actually were approved for PPP funding. I mean, you're really looking at detailed record keeping employee by employee. So just keep that in mind. And again, I recommend getting through CPA on that. And then I'll just, Diane, if you don't mind, I'll skip the next slide as well. But yeah, okay, there you go. So again, just in summary, the bank can help with any of the record keeping requirements. You know, as we navigate, I think the activity is going to pick up dramatically in the next 30 days with your respective financial institution. If you haven't heard from them yet, I think most of us were kind of waiting to see what Congress would do with the streamlined forgiveness process. So stay in touch with your banker and CPA. I mean, they're going to help to guide and inform you. You do have time to apply for the forgiveness, so don't feel like, you know, you're in a super rush here. I've had people that, you know, and rightfully so, have been a little bit anxious and wanting to move forward. So, you know, my only advice would be patient, get organized ahead of time. And as far as a timing standpoint, I would say within the next month or so, many banks will begin releasing their forgiveness process on a broader scale. So that's all I had for my part of the presentation, I believe, and I'm going to turn it back over to Diane.
All right. I'm going to cover a couple of topics here to end this in the accounting and tax world. And there are really two issues we're going to talk about. One is how to treat this for tax purposes. And the last issue we're going to cover briefly is the President Trump's executive order related to employee payroll tax deferral. So as far as the accounting treatment, and if you all are a business that gets a compilation, a review, an audit, you may be aware that sometimes the rules are different for book purposes, what we call GAAP versus tax. So let's talk about book first, and I'll try to make this as clear as I can. There is no FASB standard on the topic. And as you know, in that world, we deal with FASB standards. The FASB has voluminous standards on all kinds of things, but I guess never in their wildest dreams would they have dreamed up this sort of a situation where business entities have the government is routinely forgiving loans. So what we have on the topic are about 4 or 5 different FASBs, which I'm going to touch on briefly, and I'm just going to touch on them enough to say what the result would be if you relied on those. And since there is a little bit of choice here, there's no hard and fast rule. But the first two I've got on the screen are FASB 470 and 450. One has to do with forgiveness, and it really deals with more in the nonprofit world, where a lot of times there are government programs that for some debt can be forgiven based on achieving certain milestones. So in FASB 470, this one says that you reduce the liability. In other words, you would record this as a liability and reduce it and record a gain once that loan is partly or wholly forgiven and legal release is received. So in our mind, that is when the SBA approves and notifies the bank, because that's when the funds flow, correct, Todd, from the SBA to the banks, and that loan is taken off your books. So in this case, under that FASB, you would keep a loan on your books until the SBA notified the bank. The second one is what they call a gain contingency FASB, and it is in that one, you would have a gain recognized when all the contingencies related to the receipt of the assistance have been met and the gain is realized or realizable. So in our minds, that would still be when the SBA approves and notifies the bank. Now, the legal field would say, well, you don't really know till the 6 years is up, but that's probably an extreme position. Most people would take the position it happens upon SBA approval. A couple more, just to make this muddier. There's an International Accounting Standard, which is another body of standard setting that we have to deal with. In this one, there's a standard that deals with government grants. And in that case, they allow you to recognize the gain earlier. And it's when if it is expected to be forgiven, you can utilize this standard. There would need to be reasonable assurance. In other words, the bank would need to clear it, and you would need to have reasonable assurance that the SBA was going to approve. So in other words, this is more of a reasonable assurance threshold. And at that point, if you relied on this standard, you could take the liability off your books earlier than those prior two standards that I explained. And then last but not least, we have another FASB 958 that deals right now solely with not-for-profits, but we're going to take the not-for-profit treatment and analogize it to for-profit entities and say that this standard would, if you look at bullet point 2, the timing would be based on whether the contribution is conditional or not. And if it is conditional, the contribution would be recognized when all the conditions are substantially met or explicitly waived. In that case, the entity would then reduce the liability and recognize the contribution, again, under that substantially met or explicitly waived standards. We believe this is likely upon bank approval. So, I mean, after hearing this, I'm sure everyone is at least somewhat confused. And the problem is we don't have a standard on point, and we have this issue that this process is going to go on for months, and it is likely that every client will have a year end in the middle of it, because most clients have December year ends, and we do not have confidence that the SBA will grant forgiveness to the larger loans until early 2021. So let me just review. The most important thing is you've got financial statements. You need to disclose what you're doing so that the bank or any other interested party knows. but there are 4 standards, or at least 4 different bullet points here that deal with this. The safest is to probably wait until the SBA approves. But if you're in a position you really would like to get this off your books for some other reason, you're going to need to look at the IAS Standard 20 or ASC 958. And again, we just point out here that virtually every client's going to have a year end with this book accounting problem. Now, to make it worse, we have a tax problem too, because we do know that the loan itself, when forgiven, that's tax-free, but we also know that the expenses paid or incurred with those loan proceeds are not deductible. You couple that with what I just said about how long do you keep the loan on the books. For book purposes, we would say you keep it on until the SBA approves, and you don't recognize any kind of gain until that happens. So here's our fact pattern, and you'll see there's multiple options. Let's say year 1, you treat it as a loan with no adjustment of expense deductibility during that year, because you're waiting for either under option 1, a notice of forgiveness from SBA, or under option 2, a presumption of forgiveness. So at the end of December, if you're going to keep a loan on your books, and for tax purposes, you're going to keep a loan on your books, you don't have any kind of expense non-deductibility at that point. The problem is the IRS going to allow this? It seems like it's very beneficial to taxpayers because it throws the non-deductibility into another tax year. Very, very unclear. Because if you look at year 2, let's say the forgiveness occurs then, so at that point, the expenses are non-deductible. 3 options. The non-deductibility incurs in year 2. Option 2, the non-deductibility occurs retroactively in year 1, because those are when the expenses are incurred. Or option 3, we're going to do an amended return. Those are very, very problematic options, because sometimes these loans are large. There's a huge amount of potential non-deductibility. And as we said today, we don't know whether to tell you to pay in estimated taxes as if those are going to hit 2020 or 2021. And then the additional issue is the R&D qualified expenses. So we feel like there's probably going to need to be some extended returns, unfortunately, until this gets to be ironed out, unless Treasury comes out with more clarification around the timing of the forgiveness. And to throw even more issues in the hopper, I'm sure you all are mostly aware that President Trump, contrary to Congress's support, felt it in order to put in a employee payroll tax deferral. It's in effect right now. It allows the deferral of the employee portion of Social Security, and these are on employees that make under certain amounts of $4,000 per pay period, per biweekly pay period. So if you've got employees in that category, you as an employer can choose to defer withholding of those Social Security taxes and repay them in January through April of 2021 through withholding. The employers can choose to offer this or not. And then if employer decides to offer it, the employees can opt in or out. But the problem is the employer is the one on the hook for these deferred amounts. And if that employee leaves, then employer would need to be able to withhold it in some way before they left. Very problematic for certain employers who have a lot of turnover. So the challenge with the new rules is the employer is responsible for paying it, whether the employee is still employed or not. The difficulty in collecting from a terminated employee, and also the burden for employees to have double withholdings in 2021. The kicker in here is Trump also said that these amounts may be forgiven. So employer, at first blush, you'd say, well, just don't do it. It's too much risk for your employee base. But if this were to be forgiven, we're not sure it would be forgiven if you didn't participate. So then employees would have had payroll taxes totally waived, never to be withheld. And because you as an employer did not participate, they're not able to receive that benefit. So not a great day in the employer world if that were to happen. So as far as recommendation, we're saying look at the riskiness of your employee base. If it's really risky about turnover and your inability to obtain these monies, opt out and don't utilize it, knowing that this could come back to haunt you if that amount's forgiven. But if your employee departure risk is low, when you feel like you can recoup this, it's in your best interest to participate, both from employee morale and not get into a political quagmire if this does become a forgiven situation. Of course, be careful with your payroll outsourcing companies because they're struggling with administering this rule. Because with anything right now that comes out, it is proposed, it happens, and it's rolled out virtually immediately. And it's really difficult for any of us to keep up with all the nuances. All right, Brian, I think I've given you all the complications that anybody can handle for the last hour or so.
You've both done a great job, and thank you. So I'm going to talk just for a minute about next steps. What's going to happen? So the House several weeks ago passed a HEROES Act, which was a new stimulus proposal, and that had a $3 trillion price tag. The HEALS Act later passed the Senate with a $1 trillion price tag. As you may have read, this week a skinny stimulus bill was introduced, and it was voted down in the Senate yesterday. And there are varying reports on the all-in cost from 300 to 500 billion. But that was voted down yesterday. In the skinny stimulus bill, at an estimated cost of $257 billion, it did create a second round of PPP loans. It reduced the headcount requirement for eligibility. It introduced a specific revenue loss requirement of 2012 versus 2019, which I believe is on a quarterly, tied to a quarter, to be eligible for a second PPP loan. The maximum loan amount was reduced down to $2 million, and then it introduced a simplified forgiveness process for loans of $150,000 or less. So in terms of forecasting what happens, one thing to keep an eye on is this role of employer liability protection, and it's an important issue for the Kentucky Chamber and the Kentucky business community. But Leader McConnell in the Safe to Work Act, which was part of the Senate's HEALS Act, has made several statements saying there will be no additional stimulus measures passed if employer liability protections are not included. So when you're looking at, legislative action with respect to the PPP program, Leader McConnell at this point has drawn something of a line in the sand on the employer liability piece. in addition, when you're trying to handicap the possibility of automatic PPP loan forgiveness, I think that there was some, well, my feeling anyway, is that there was momentum as to that issue within the last several weeks. One thing to keep in mind is the role that these announcements of fraud, how does that impact the way lawmakers are going to look at just blanket forgiveness for a big chunk of these loans. And yesterday, you may have seen the Justice Department had what they called the PPP Criminal Fraud Enforcement Action Press Conference. And at that press conference, the Acting Assistant Attorney General announced that since May, the Justice Department has charged 57 people with trying to steal more than $175 million of PPP money. And it also said they're investigating many others. Now, I've read the case summaries for a lot of these, and the feds have recovered various things that have been purchased with PPP monies, and that includes Lamborghinis, a Tesla, Rolls-Royce, Rolex watch, 6-carat diamond ring. You can probably use your imagination and to think about what else might be on the list. I will say that it appears so far that the fraud cases that are being reported, it involves pretty brazen behavior, outright fraud. And people using, there are very specific use limitations with respect to the PPP money. There are instances where applicants said, actually, they said they had hundreds of employees, they had zero. They filed applications in the name of fictitious companies. They filed them in the names of real companies, but the applicants didn't own the companies. They submitted fake documents, fake IRS filings, which I would think that that's going to be difficult to pull off. There's instances of identity theft, applying via an alias, and then there's an assortment of, Vegas and other trips using PPP money, and some pretty ugly stuff. In addition, you've got the SBA Inspector General saying, this is, quote, just the tip of the iceberg, close quote. So actually, as a percentage of the overall PPP monies, at least what's been reported to date, it's not a large percentage, but it's taxpayer money. The numbers just on them by themselves are large, and it's very bad optics for the program. So it's unclear how that's going to affect this analysis, but that is floating around. And I think going back to the presidential election, depending on how that goes, those types of fraud actions could take more of a center stage. It's hard to say. I think at this point, the three of us would all agree that it's possible that nothing else is going to happen on PPP at a legislative level until after the presidential election. Yesterday seemed to be a bit of a kind of a signal moment, but we'll see. This thing has been and remains very fluid. So I think from our perspective, that pretty well wraps things up. What I would like to say is, I know for all of us, we'd be happy to answer any questions you might have or to talk with you. Our email addresses, I know, are listed on the slides. But please feel free to reach out to any of us at any time. And if you don't have our information, I'm sure you can search through the internet, or Kate can get it to you. But it's been a real pleasure for all of us to put this presentation on. Hope it was helpful and informative. And at this point, I'd like to turn it over to Kate.
Thank you so much, Brian, and thank you to everyone for joining us. I want to thank our panelists today, Diane Medley, Brian Cromer, and Todd Frossard for joining us and lending us their expertise. This is obviously a very complex issue and a lot to cover, and I think we covered a lot of content today. And as a reminder, we will be posting this on our Restart Kentucky website. If you visit kychamber.com and click on the Restart banner, you will be able to find a recording of this presentation if you need to revisit it. And please be sure to follow us on the social media platforms. We're on Twitter, Facebook, Instagram, and you will see updates for upcoming webinars and future discussions that we'll be holding. And with that, I want to wish everyone a happy weekend upcoming, and thank you again for joining us. Take care, everyone.